Good morning, or good afternoon. Thank you for joining us. We're excited to have you here today. ALM 201, Leveraging Your ALM Report. This is the second in our ALM series of the year. Did ALM 101 a few weeks back and off to ALM 201 now. So we're excited to talk about it. Obviously, a lot of things happening in this economic environment and changes of interest rates that's really putting ALM into the spotlight today. So we're excited to talk about it. The next slide here, just a little bit of administration. There, if you move your mouse around on your screen, you'll see the Q&A button, usually on the bottom. And feel free to submit a question at any time. We'll answer them throughout the webinar, or we'll answer them at the end, depending on when is the most appropriate. Please feel free to submit any questions at all. Today's webinar will be recorded and available on our YouTube channel, as with all of our previous webinars. And if you'd like, please reach out to your advisor, your McQueen Financial Advisor, and they will send you a link to it or copies of the slides. So today I'm really excited. On the next slide here, I've got an awesome presenter with me. Well, we can skip me, Charlie McQueen here, but we've got Heather. Heather's here with me. I'm super excited. Heather's responsible for all things ALM. And included in that activity is CECL. So Heather's got a lot of great stuff going on with the implementation of CECL right now. Super excited with that, and also all of our activity in ALM. And she's got an incredible team supporting her and working with her. And Heather, thank you for joining me. And
Thanks for having me.
You're welcome. And those that don't know, Heather is responsible for that, again, ALM and CECL. We also have an investment advisory division and our valuation division. So really, really great, exciting stuff going on here. We're going to go to the next slide here, and Heather's going to kick off a little bit about what she wants to talk about today.
Charlie, welcome everybody. Thank you for taking the time today to join us. We're going to take some time to ensure that we're going to do a little bit of a recap of ALM 101. But before we get started, we definitely want to know what's going on in the economy. And Charlie's going to bring us up to speed on what's going on. And then we're going to try to incorporate that into some of the pieces of the ALM that we're going to discuss today. We're going to review what we looked at ALM 101 and then step into a 201 that's going to dive a little bit further into model assumptions that are so vastly important to ensure that the output of ALM is making sense for our institution. And in order to understand that, we have to look at these model assumptions. We have to understand the cash flows and repricing and what that duration looks like on our balance sheet, and understanding how that impacts our spread and our margin so that we can make informed decisions. And we have some really fantastic moving pieces here that we're going to look a little bit further into today so that we can understand this a little bit more in depth than we did at that first initial high level overlook as a 101. So we're going to have a little bit further into the conversation, but again, keeping this very high level, making sure that we understand how these moving pieces are impactful for us.
Cool. Well, thank you, Heather. It's going to be some neat stuff. We're going to talk about assumptions and repricing and making some good decisions is one of the things I'm really looking forward to. With that, as we kick off, I want to spend a couple of minutes talking about the economic environment. And, you know, you can tell my level of cartoon and character and movies at our house. I've got the Move here from the movie Move. We're excited. Rates are rising. It's a positive because margins are going to start to go up. You know, we've been in this terrible margin environment for quite some time now. And the chart here on the right-hand side, the community-sized institutions is in the kind of gold color, and then the billion-dollar plus institutions are in the blue color. And the margins have really fallen apart, but the good news is we're starting to see them come up, and we'll see them actually come up quite a bit with where interest rates are. And since most of us make a vast majority of our earnings from margin, this is going to be really, really helpful. So looking at the next slide, I did say interest rates are rising, and here is how much they have risen. It's truly been amazing. The market has gotten way ahead of the Fed on the viewpoint of where rates should be. We've seen a dramatic upward shift to the yield curve and a flattening of the yield curve. And you can see here at the bottom, it's really incredible. Some of the change numbers are just amazing, but you know, we're pretty close to a 3% yield from the 2-year Treasury, even the 1-year Treasury being just shy of 2, but the 2-year Treasury at 271 all the way out to a 10-year at 319 when this picture was taken on May 9th. So really, really flat yield curve. What does this tell us? Well, this tells us that the market is saying that, hey, inflation's here, which we'll talk about. Rates should be higher, but they don't have to be higher forever. We don't need really, really high long-term rates because we think the future is not going to be as inflationary as today. So definitely a unique structure of the yield curve. The black dotted line goes back to December of 12, and we've kept that one the same since then because interest rates really didn't move for a long, long time, and then popped up from there a bit. But a lot of changes here, and a lot of this is impacting the NEV calculation, the ALM report, and I know Heather's going to talk a bit about that. So next slide is one of my favorites. You guys have seen me present this a lot of times. Fed funds rate is the red dotted line, the blue line is the 2-year Treasury, and the black dotted line is the 10-year Treasury. You can see the last couple times the Fed raised rates back in the beginning of breaking the housing bubble in 2004 or 5, and then most recently, or Heather just was the pointer a second ago, going back to 16, 17, 18, is the economy was recovering, and it was recovering, and the Fed was slowly raising rates, and then we kind of ran into a little pandemic. So what you'll notice here is that we are seeing a dramatic upward rise of all interest rates. Everything was low, then everything shot up here, and that's just something different than what we've seen, the shape of changes and the time. If we look back over history, we've basically gone from 0 to near 3% with everything. So very, very rapid increase, which is again causing some unique ALM situations out there today.
And this is extremely timely because we're going to see this as we start to dive into some of our numbers and some of the trends that we've seen over the last year and the changes that we're already starting to see on our balance sheet just over the last couple of quarters.
Yeah, definitely big swings in just a very short period of time. And speaking of big swings in a short period of time, here you can see the Fed on top, the Fed funds target rate. Then we did that bump up as the economy was doing well. They bumped up about 25 basis points a meeting for a year and a half there. Got us all the way up to 2.5%, and then we dropped right away back down to 25 basis points. But here you can see the big change. We did go up 25 basis points. A lot of people thought the Fed was behind the curve then and should have moved faster and more. Then they jumped up 50 basis points this last meeting that just passed here. A lot of other components too. Not only do we have the Fed funds rate that is going to modify monetary activities, we also have the dollar amount that they have of their purchase securities portfolio, the quantitative easing portfolio, and they bought all these dollars, and they're going to start letting them run off here, and that's going to start to affect activities too. They're going to be buying a lot less securities, is the term. So, couple comments, couple different things, long-term, short-term, a lot of different movements by the Fed. With that, we do have the Fed funds meeting dates and the applied rates on the bottom here. And the market is the direction is usually right here. The Fed funds futures don't always come through. This is betting in the market. We do agree with them though. On June 15th coming up here, the Fed will most likely raise rates 50 basis points. They've telegraphed that pretty clearly. And so we'll be up to 150 on the Fed funds rate on June 15th. And then from there, it starts to get a little bit fuzzier. The market is predicting we go all the way up to 3% by year end at the high end on December 14th. We're a little bit lower. We're closer to 2% is where we believe we're going to show up at that point, but we do think rates are definitely coming up. Then this chart every day will change. So it is going to be a bit of a different because this is the betting in the market. But we're definitely expecting rates to come up. We do agree with 150 on June 15th, but then a little bit slower as we move up from there. So the next slide here, it really is why rates are coming up. And a couple of you have heard me say this before. How do you get inflation? Well, step one, apply lots of cash, and that's that top graph, money supply. We had about 6 years worth of money supply growth that happened in about 6 weeks, we could argue, but a year and a half. So massive amount of money was thrown at the system by the government. And what was the result of that? Well, you have a bunch of money, and then you have a supply chain meltdown, kind of step two, and the result here is this big boost of inflation. So inflation is substantially higher than we've seen in a long time. The consumer price index, the raw number, including everything, is running at 8.5%, ex-food and energy 6.5%, and the PCE 5.18. One of the things to remember is, when I finish my day working, theoretically you get a paycheck, and then you go home. While driving home, you put gas in your car and food in your car, which then reduces your spending capacity. So the consumer price index, especially including food and energy at 8.5, will actually slow the economy quite a bit, and we're going to start to read more about people struggling to pay all the bills and to handle food prices and gas prices. So definitely going to be a little bit of a negative impact there to growth. So looking at the next slide here, we haven't been at this rate of inflation since 1982. We do have the transportation problems with COVID that are still in place. We do have transportation logistical problems with the war that's taken place, and all sorts of bans on flights and travel. So it's going to be a bit of an interesting time. It's going to take some time. Things will improve. We're hopefully going to see inflation start to die down here a little bit, taper down a little bit, but we do expect there to be quite a bit. Wage-based inflation does become permanent, even if people talk about it being transitory, because at first it can be, but eventually it's permanent. But some of the big offenders here are gas prices, 45% auto, 40% furniture, which why would furniture be up 20%? Well, it's transportation and manufacturing and buying raw materials. All those are up substantially. So with that, just the last couple comments. Unemployment rate is looking really good. I'd wish more people would enter back in the workforce, but what people care about today is flexibility, and giving good flexibility to employment is what's working. But we are now back at post or pre-pandemic levels in unemployment rates in the country. From there, we do expect on the next slide that we are seeing a little bit of a slowdown in the housing market because we've now hit a little over 5.5% on 30-year mortgage rates. That's definitely going to cause some affordability problems, but there's still a lot of people looking to buy houses and a lot of transitions happening. There's a lot of people that lived in their houses for a long time, but millennials are becoming bigger and bigger home buyers, and we do expect there's going to continue to be some geographical shifts as people can work remotely from a lot of different places today. So with that, just a couple things. We are a little nervous about gas prices substantially up, and those will potentially slow the economy a bit. Crude oil futures continue to be really high. We hope that we can get this back under control here. We all want to have an electric car to make life easier, but we're going to have some hard times with some of the materials. Going to the next slide, it has been an interesting couple days in the market, so I wanted to throw it in here. NASDAQ's down substantially. The S&P 500 is down quite a bit. Top graphs S&P 500, bottoms NASDAQ. We're still up quite a bit over the past, past few years post the pandemic dip there and the little recession. So we still are doing pretty good, even though things are down quite a bit. But this is going to make people think a little bit and potentially, again, slow the economy a little bit as we've predicted. So with that, I do believe that we're in a good economic environment where we're going to see margins improve. I do think there's going to be some bouncing in the stock market. We're probably going to see a little bit of a slowdown. We've predicted, and everyone should have a copy of our Q2 economic outlook. Things slowing a little bit, but overall, we don't know if there'll be a recession or not, but the economy should be okay for a bit, and we should also see some decent earnings because of the improved margin. So with that, I'm going to hand it off to Heather, who's going to hop into the first ALM slide.
Thanks, Charlie. So just as a quick recap of what we reviewed in ALM 101, we had looked at this idea and this concept that ALM is a little bit of science and a little bit of art. That science side being the accounting, going in and ensuring we're capturing all interest sensitive products, because that is the focus point of asset liability management, is what is our interest rate risk? Anything tied to an interest rate, all of our loans, investments, deposits, and borrowings. And when we look at the accounting side, we're making sure that we're capturing all of those moving pieces. And then once we get into the model, that's where the art comes in and the finance. We bend and twist the market in different movements and let's see what happens to our balance sheet at that point. What does our risk look like? Do we find that balance between our assets and our liabilities? That's where that teeter-totter comes into play. And the two main moving pieces of risk management is looking at our net interest income and our net economic value of equity. So as we dive into those outputs, there's a lot of moving pieces that happen behind the scenes that actually impact and flow through to our risk position. And that's what we're going to dive into a little bit more today, and the importance of the model assumptions that we use to determine what our risk looks like. We need to ensure that those assumptions are appropriate for our balance sheet and that it gives us an actual proper measurement of our risk position. Now, do we want to be conservative and make sure that we're not making everything look very rosy? And that's exactly what we want to do here here and what we're going to look at today. That balance between risk and return, that trade-off. Are we taking enough risk so that we can try to maximize our bottom line, maximize our margin, take advantage of the movement that we just saw on the economic side of where rates are going? Where are those opportunities? Not to leave too much cash on the table and miss a chance of earning a higher interest rate. We know rates are continuing to move upward, but that's where that ladder comes into play to ensure we're constantly moving that cash, reinvesting, focusing on lending, and making sure that the liabilities are appropriate to be able to support what we're focusing on. And using the ALM to be a proactive decision-making tool. We want to make sure that what this information gives us helps us decide on what is the best next step for us based off of what the market is offering. So as we get into looking at our risks, and just as a recap of understanding our interest rate risk, we're going to look at both net interest income sensitivity and NIV sensitivity. And as we go to net interest income, just as a refresher, this is looking at simulating the earning sensitivity over the next 12 months. And when we look at net interest income, we're looking at the income that we are expecting over the next 12 months on all of our loans and investments, netting out our expenses on our deposits and our borrowings. And when we do a shock test, this is that examiner kind of worst case scenario. And we also have a gradual test that we use in the ALM model, which is a great management tool test that slow, steady change over time. This is something that we're experiencing right now. Every time the Fed meets, they're starting to raise interest rates. We've been experiencing this over the last few meetings, and we're expecting to see that continue to happen. So as that continues to move, what is that going to look like for our balance sheet? And when we look at this bottom graph here in the bottom left corner, we're looking at this 1 year forward projection of net interest income, all of our loan income, investment income, and reducing this by our expenses. And when we look at our base case, this is assuming that nothing is changing. Interest rates are staying flat, and over the next 12 months, nothing is going to move. And again, assuming a static balance sheet. We have to use this as a baseline, and we're going to talk a little bit more today about some simulations and some what ifs, because we know balance sheets do fluctuate and change, and we do want to capture that side. But we want to use this test as our starting point of a static balance sheet, assuming there's no movement or changes of interest rates or balances in the next 12 months. So when we look at our base case and assume what that net interest income would look like over 12 months, does this seem reasonable for us? Are we capturing everything correctly? And if that is the case, what does our sensitivity look like? And where are our opportunities? We're using this output to guide us in comparison to our policy limits that we've established to ensure that this is a proper amount of risk that our balance sheet can handle. And as rates start to change and we start to move with the market, are we in a position to maximize what we can and try to maintain a nice healthy position that's well within that policy and seeing that income shift and change over time? So this is that first step of looking at where we stand in our risk position. And then as we go to the next step is looking at our NIV sensitivity. And this is looking at a snapshot in time of when we're running this report. So say if we're looking at our March 31st, we're looking as of that day, what is the value of our balance sheet in the market? And the longer duration we have, the more risk we may take on assets, such as 30-year mortgages. In 2021, we had a lot of opportunity for a lot of refinancing and new mortgages coming onto our books because of low interest rates. Well, as rates have continued to increase, and as Charlie had mentioned earlier, we're over 5% for a 30-year mortgage. Those prepay speeds are going to slow down because that incentive to refinance or take on a new mortgage isn't as favorable if rates are higher for the consumer side. So as that continues to happen, we assume that our cash flow is going to take longer to come back. We're not going to see that refinancing happen as quickly. So as that duration starts to lengthen out, do we have enough room in our risk and our value to make sure that we're still within that policy limit? And we're going to get a little bit further into this today, looking at how all of these things impact and change the structure of our balance sheet, in turn changing our risk position. So as you look at the output of net interest income and NIV, we want to assess our risk position. Is this output surprising to us? Are we comfortable with the results? Can we and should we add duration and add a mix? This is where we're using the output to help guide our decision making in the future to ensure that we're doing the right things in the right combination for our balance sheet. And then will our budget plans move us in the right direction? We're going to have to do some simulations and some movements of the balance sheet to see if we compare it to our baseline and then look at what our budget plans are. Does that still keep us in a normal, healthy range, that good balance of our assets and our liabilities that's appropriate for us to make sure that we're maximizing our margin, we're keeping a nice, healthy capital position. Right now, that's a very difficult thing to do, looking at the amount of deposits in the market that's really increased our balance sheets, making it harder and harder to maintain a nice high capital position. But this is the benefit of what's going on right now with those higher interest rates, is we're finally starting to see that margin start to turn around. And then the final thing here is making sure we have the expertise to execute these strategies. If we want to look into commercial lending, do we have a good lender on staff that knows how to do commercial loans or mortgage loans or whatever route that we would like to go, making sure that we have the right plan in place and we have the tools internally to be successful at it. So as we get into the model assumptions, this is kind of that next starting point of diving further into the ALM and ensuring that the assumptions that are being used are appropriate for our balance sheet. So we started off with the science part, the accounting. We've tied everything out. We've captured all of those moving pieces, and now we've incorporated it into the model. This is that next step of detail that we want to understand and look at and make sure that this is making sense to us. So one of the first pieces is looking at our betas, or you may hear this referred to as rate sensitivity factors, or RSF. This is looking at how fast are we going to respond to the market as rates start to move up or down, of how fast we're going to move our rates with that. Do we want to be competitive and try to bring more loans on our balance sheet? And if so, we may kind of have a little bit of a lag of those rates and how fast we move those up. Or our deposits. Are we trying to bring certain types of deposits in the door? Are we pricing that in the right way to be able to bring those in and back up what our plans are for that asset side of the balance sheet? So we're going to kind of look at some of these moving pieces and making sure that this makes sense for the products that we have. Looking at our prepayment speeds. This is largely impactful when we're looking at a lot of long-term types of products, such as mortgages. This has been a big focus point over the last couple of years due to interest rates. So as the market starts to shift and change and we see those interest rates rising, how does that impact our cash flow? How does that impact our risk position? Are we looking at these in the right manner, or are they appropriate for us? And then the last moving piece of assumptions that go into the model is looking at our non-maturity deposit retention. This is the only interest-sensitive product on our balance sheet that doesn't have a contractual maturity or call schedule or anything of those lines that gives us an idea of how long these deposits will stay with us. So there's many things that we can do to test that and to ensure that we understand how long we would assume that we can depend on our core deposits with the institution so that we can utilize those funds to move into our lending and our investments. So ensuring we have proper model assumptions gives us accurate output. So if our assumptions going into the model are inaccurate, we're going to have inaccurate results. And this is why this is so important, because these moving pieces directly impact what our net interest income sensitivity looks like and what our NIV looks like.
Heather, one of the things we look at these, how often do you review and look at each of these and make sure that they're correct? What's a normal cadence that we should be doing at our institution?
It's a great question. And sometimes that can vary, but as a general statement, to at least look at these on an annual basis is ideal. We want to relook at this, see where we're at. What have we experienced in the last year? Are these still reasonable for us? Because in a raising rate environment, we may act one way versus as rates come down, we may act slightly differently. And we can review those in each of those rate scenarios, but then also taking into consideration what we've experienced over the last little bit of time, we may want to review that more often. We saw that in 2020 with the very fast movement and shift with the pandemic. Some of these assumptions very quickly were no longer reasonable. So making sure that we're reviewing these on a standard schedule is the best practice that we can do, but then also taking into consideration when we have these non-expected movements in the market, we want to continue to review these to make sure that that's relevant of what's going on currently.
Thank you, Heather.
Thank you. Okay, so as we go into our betas and our rate sensitivity factors, there's a few things that we want to look at and consider when determining what's appropriate. And one of the first items that we always want to look at is if a product is a fixed rate product or if it's a variable rate product. And this is really focusing in on those assets, looking at our loans and our investments. And we know as a general rule of thumb, variable rate products are usually tied to an index in the market and move in lockstep as the market starts to shift and change. Therefore, you're going to see items such as this bottom line item right here, looking at variable rate mortgages and making sure that we have our current replacement rate of what we would expect those rates to be here going on our balance sheet in the future. And then as rates start to move up and down, we want to be able to move in lockstep with the market. If we know we have a product that's tied to say prime, and prime is going to move, we want to move in lockstep with it. Therefore, we're going to use a 1 or that is 100% or 100 basis points, moving right in lockstep with the market. So if the market goes up 100 basis points, we're going to move that rate 100 basis points when it's up for repricing. Now, it's a little bit different when we look at fixed rate products. We generally have a little bit of a lag. We're not going to move in lockstep, so to speak, but this may change a little bit from one product to another. We may want to move our autos a little bit faster or slower than we may move our recreational vehicles. This is where you're going to look from one product to the next. How do we want to price these to be able to get the cash or get the flux in of the products that we're looking to do? Are we trying to be more competitive? Do we want to move these but not as quickly to try to bring more of these types of items onto the balance sheet versus other ones that we're going to be comparing to other institutions that are our competition, because say the auto loans are harder because of the competition in our area, but we've got some more room that we can move a little faster with recreational vehicles because there's not as much competition there. Another item to keep in mind is looking at when we're looking at variable rate products, our caps and our floors, but also our periodic caps. If we look at a product such as, say, HELOCs, this is a great opportunity right now. We saw a lot of mortgages be refinanced or come onto our balance sheet in the last couple of years because of low interest rates. Now that rates have moved in the manner that they have, there's not as much incentive to sell your home. But because of the increase in values of our home, we're seeing a lot more demand for equity types of products. We're seeing a lot of updates to homes and remodeling kitchens and deciding to just reinvest that boost in equity that we see and putting that back into the home. So as we look at these items, how fast can we move these rates as we're seeing more and more demand here? If the Fed decides to continue to move rates upward, are we going to get the benefit on these products? Well, if we have a periodic cap, that means that over the next 12 months, we can only increase that rate by 2%. So if the Fed decides to move 2.5, we can only go up 100 basis points and up 100 and 100 basis points in the up 200. Then that means that we need to make sure that that is where we stop, because net interest income is looking at the next 12 months. If we have caps and floors, we need to make sure that we stop those rates once they reach those caps and floors to make sure that we're capturing the proper amount of interest income that may come in and out of our balance sheet. Now, when we look at our deposits, we have not as much of a response to the market when it comes to our deposit pricing. So this is something to look at when we look at our money markets or checking accounts. If we're looking at a money market, we know these are more interest sensitive, meaning that our depositors are really looking for that higher interest rate, and they're more willing to move this money from one institution to another to get that rate. Therefore, we're going to be a little bit wider on our assumptions on these products than we would on, say, a core checking account. We're going to move the checking account interest rate up, but we're not going to move them nearly as fast as some other products that may expect to have a shorter life with the institution, that may start to be more rate sensitive and move a little faster. So we want to look at what activity have we seen in the past past, and do we expect that to continue? And making sure that how we structure these costs are appropriate for what we're trying to accomplish. Charlie, have you seen a lot of competition with checking accounts and money markets right now? Or are we seeing this kind of maintaining?
Yeah, it's interesting. I almost think it might be the third answer. I expect people might be wanting some runoff because of the growth that there's been in these accounts. So, it is interesting. Not only do we look at this from the economic environments, but we look at the change of growth of deposits. People are not going to want to raise deposit rates as quickly as maybe they have in the past because of the lack of want. And we see some people with capital issues, low capital because of deposit growth. So with that, these numbers also, they don't have to be 35 or 20 basis points across the board. You can raise 5 the first 100, maybe you go up 10 the next 100 and 30 the next. So just you can have some variability in those numbers also.
And that's the great part about these models is we have the control of putting some lags in there. And that first 100 basis points, we may wait it out just a little longer before we're going to respond. So we may have a lower amount in that first 100 basis points, but then catch up in that up 200. So just be sure that it's right for how we want to respond to the market. So touching on prepay speeds, this is one of those items that's essentially counterintuitive in regards to the movement. So when we see higher interest rates, we're going to see slower prepay speeds. And if we see lower interest rates, we're going to see faster prepay speeds. And I find it a little interesting looking from March of last year to March of this year, where we're seeing a very large increase in interest rates as time has gone on, and prepay speeds are lowering, but they haven't quite caught up as of March 31st. But we're going to touch on this in just a moment. But as rates go upward, that incentive to refinance starts to reduce, because if you have an interest rate on your balance sheet that's say around 3%, but the market's offering 4%, I don't want to go out and pay more for that loan. Therefore, those speeds are going to start to slow down because that incentive is not there. And we saw a very large increase in prepay speeds as we start to see these record low interest rates on lending. So that's why we saw these speeds just skyrocket over the last year or so. Now that's starting to catch up. As of March 31st, we started to see rates really start to drop, and you can start to see this drop start to happen here. But looking at April speeds, we saw some of these numbers and say a 30-year mortgage rate, looking around a 30+% prepay speed as of March 31st. But when we looked at the April speeds, they dropped into the single digits. And that is a response to those higher interest rates on mortgages. So we're going to see when that occurs, because there's not as much incentive there, our cash flow is going to get longer with our loans and our investments. So we have to keep that in mind when we look at our NEV position and that net interest income sensitivity. We're going to add sensitivity because the expectation is it's going to take longer for those items to come in. Looking at non-maturity deposit retention, as we had mentioned, is how long do these deposits stay with the institution? And some trends that we've been noticing here in the last couple of years is the fact that we may have less accounts, but we're significantly larger balances. And a lot of that has to do with the influx of stimulus packages that have gone into the market, seeing a very large increase in our overall balances in each of these products. So looking at retention rates that we're seeing with these items, we want to make sure that we are checking to see how long do our deposits stay with our institution. Do we have a retention term that's appropriate for the activity that we see? And that changes over time. We do run core deposit studies looking at the legacy of what is those patterns? How fast do these deposits leave the institution? And as time has gone on, we've seen retention getting longer and longer. We're not seeing as much incentive to go elsewhere, as we had talked about with not having that higher interest rates and not needing those deposits. We're seeing some retention get a little bit longer, especially when we're looking at our core deposits, such as checking accounts and savings accounts. But when we look at money markets and IRAs, that may have a little bit more sensitivity to it. Ironically, we saw a little less retention in money markets over the last couple of years, but we're seeing those IRAs actually start to bump up a little bit. So as these patterns continue to happen, that holds a lot of value for NEV the longer these deposits stay with us. us. But our expectation here as rates start to come back up is we're going to start to see these start to move out again. We're going to see consumer spending and deposits start to reduce, but we probably are going to start to see some competition and some rate shopping occur. So continuing to measure how long those deposits stay with us, that's going to fluctuate and change over time. So we need to make sure that we're reviewing these. Charlie, you had mentioned earlier how often should we review these assumptions? Deposits don't move nearly as quickly as other moving parts of the balance sheet. So we usually review this about every 2 years. But with the activity that's going on right now, this may be something we want to review a little bit more often, but definitely something to definitely monitor.
Yeah, I appreciate that, Heather. And as you flip into your last slide here on the assumption side of things, I do think it's important when the economy modifies, such as maybe we're going to a little bit of a slowdown here, people are going to act differently. And it's time to really think about all those assumptions. And it's a great time to sit down and review them.
Oh, absolutely. So as we review these, we want to make sure that they're reasonable, and we want to make sure that we're reviewing this on a fairly consistent schedule. We want to run these what if scenarios. We want to check our budgeting. We want to make sure that all of these moving pieces on our balance sheet are still reasonable for us. And sometimes, depending on the size balance sheet we are and examiner expectations, they may be asking for some model validations by a third party. During those examinations, they're going to be going in and looking at our assumptions. Do those seem reasonable for us? So we want to make sure that they are supportable. So reviewing these on a consistent basis is a very important when we have to do a validation, because that's exactly the items that they're going to be looking for to ensure that they are reasonable. So taking all of these pieces into consideration, we want to look at how our cash flow is impacted by that. So when we look at our loans and our investments, we do have some prepayment behavior that's going to change what that cash flow is going to look like. And depending on that repricing to maturity schedule, that will be impactful of what our risk is going to be, and then making sure that that duration estimates make sense for us. So as you get into the detail and the breakdown of what some of these cash flows may look like, you have a nice kind of breakdown of seeing over the next year or 2 years, what does this look like for us? How much cash is coming in? What do we need to do with these funds? Are we reinvesting appropriately? Are we taking into consideration the next time that rates are going to reset? And how does that respond for us? Looking at items such as these HELOC products that have usually a quarterly reset, that is going to be some benefit for us. We have some great opportunities to take on some equity loans, but with that, there are usually variable rates tied to the market that reset very quickly. So as the Fed starts to raise interest rates, we're going to reap the rewards of that, and that's really going to help our margin and our spread. So understanding and seeing what this cash flow is looking like over the next 12 months gives us a great tool to make sure that we are moving these funds as they come in the door back into the balance sheet in the appropriate duration, the appropriate areas where we can really maximize our spread, our margin, and keeping our capital at a healthy position. So our investment cash flow here is the same idea. If we have a lot of cash sitting in these overnight funds, making sure that we're keeping these funds going to work, checking this maturity ladder. Is this right balance for us to complement what's going on in our loans? But as we flip into our deposits, to also make sure that these are balancing on both sides of our balance sheet. Are we keeping this movement going to where we need to? Do we need to look a little bit longer in some of these term deposits, knowing that some of these that have been on the balance sheet for a little while may be a higher expense for us? So as that starts to come in and these start to reset on the balance sheet, they're going to become less and less expensive. So we really want to be able to look at the benefits that we're going to get and how we can move those funds, and understanding where these cash flows are coming from are really going to help us be able to plan accordingly over those next 12 months. So looking at our overall duration, there's some nice moving pieces within the models that usually show you kind of that balance between the two sides. Do we have a mismatch between our asset duration and our liability duration? Charlie, I know a lot of these investments, we're seeing some big movements of what the cash flow looks like or weighted average life on some of these things. Has there been a significant reduction or expansion of what we would expect to see with certain amortizing products, say, such as maybe mortgage investments.
Yeah, we've definitely seen with, as you mentioned, one of the amazing things is a single-digit prepayment speeds right now, which is causing average lives or durations to extend substantially on mortgage-backed products. And some of the ones that were maybe more surprising are some of the complex CMOs that maybe were not being modeled correctly have really jumped out significantly. And that's caused some trouble for people in both long-term investments, people that bought 30-year mortgages, but also people that bought into some money market funds. There's been some duration expansion there that's been causing some pain also. It's part of the whole thing of ALM is making sure you're looking at that whole balance sheet, and but that doesn't mean you can buy bad things here or there. We want to make sure we're buying all good things, and not looking at just the average, but every instrument individually, but also the overall structure.
Well, it is. You may have certain items that are going to offset something else, but making sure the big picture of all of these things coming together is what we really want to be able to understand. So the goal of this analysis is making sure that we can see and understand both of our loan and our investment runoff, identifying that we have a proper ladder for our balance sheet, then we can achieve our goals. Identifying that we have a proper structure for our risk position and what potential loan and investment activity do we have, and making sure that we see what's going on in the next 12 months so that we can keep those activities continuing to move forward. So as we take all of these moving pieces together, we look at these historical trends of our overall loan position with our yields on our loans and our investments, but also looking at that 1 year forward piece. This is where the margin comes into play, which is so beneficial for us as we see interest rates start to rise. We're understanding that we are seeing some higher interest rates on loans and investments. And as we start to see this forward projection looking year over year, we have really kind of fought to hold our position of where we are, but now we're starting to get the benefit of as these higher interest rates can reset on our balance sheet, assuming everything in those next 12 months as that comes due, assuming it rolls right back onto our balance sheet, we're going to be able to go to a higher interest rate, which is really going to boost this value on the asset side. But the biggest thing is really making sure we're keeping those overnight funds going to work. You can see at 33 basis points, this isn't real favorable for us when we can reinvest at close to 1.5% in the next 12 months and even over 6% in some lending. We're really making sure that we're seeing our benefits and our opportunities if things continue to roll over and move into those higher rates. The other benefit is looking at a lot of those term deposits. And if we have those left on our balance sheet as those assume to roll over in this, again, static approach, we're going to see our expense continue to reduce. And that is a big benefit with our margin when we're getting higher interest rates on our assets and our costs are continuing to come down. Now, there's not a lot of opportunity in those term deposit sides. So the big focus point is making sure we're reviewing our costs of our non-maturity deposits to ensure that that is the right level of expense that we have right now, and then just taking advantage of what we're seeing in those assets.
It is interesting, Heather. You'll get there in a second, but keep going. If we look at the number of dollars that are in CDs continues to decline. And so even though they're a higher yield, the effect of those won't be as much, and it's not going to be as big as a funding source going forward. So really good information. Thank you.
And this is where you can kind of see that all come together here because our liability cost is weighted in both our term deposits and those non-maturities. So the combination of those term deposits rolling over at lower interest rates and possibly even moving into these lower cost non-maturity deposits, we're going to see that continued benefit of reduction of our cost. At the same time, getting those higher interest rates on the assets, boosting our spread here and also boosting our margin. And this is what we want to hold on to right now to be able to maintain that higher capital position. We're going to have a higher net income and making sure that we're seeing this continue to move in that direction. So we're finally starting to see the light at the end of the tunnel and some nice, slow, steady growth here. So when we run a static balance sheet, this is a great starting point and a required starting point to look at as a baseline. And as we understand our baseline, we want to then take that and assume that we're going to see the movements that we have, say, in our our budget or looking at some loan opportunities that we may have in the market. And we want to be able to run that within the model and make sure that our risk position is going to make sense for those movements that we're hoping to do, or some, new products that we hope to dip our toe into. So we love to use the static balance sheet as our starting point or a baseline. Examiners want to see some dynamic movements or some what if scenarios. So as we start to test the balance sheet, we want to incorporate those in so that we understand what our risk position could look like if those items come to fruition. So as we start to see those movements, we want to relook at net interest income sensitivity, relook at our NEV position, and making sure that our risk and our limits are hand in hand, and we're not doing something that isn't going to make sense for our balance sheet, but also taking into consideration those market movements that we're starting to see. So as we start to look at some of these items, we want to take into consideration, what can we do? We want to continue to grow loans as much as we can. So are we going to stick with the same types of products that we have when we see some opportunities? Do we want to look at other types of products that we may not have tried in the past? Do we have too many overnight funds sitting? Have we not put those to work appropriately? Do we have some investment opportunities? Testing out all of these moving pieces to ensure that we can manage our risk position and that it makes sense for us is a great exercise to do, and one that we highly encourage. And examiners love to see that, because not only do they see that you understand your risk position, but you also understand how to use that to make appropriate decisions on what is going to be next steps for us. So here's an example of taking some cash and putting that back into some investment opportunities. So as we start to do this movement and we start to shift that cash out, move it into other products, you can see in this scenario, taking $15 million in cash and then putting that back into longer term investments, we're going to see a boost to our interest income here. We're no longer going to be earning, say, that 30, 34 basis points. We're really going to be able to take advantage of that higher, around closer to 1.5 now. We've really seen a big jump in interest rates. So taking advantage of that higher net interest income, that's where that risk to benefit comes into play. We're probably going to add some risk to our balance sheet. We're going to see a little bit more sensitivity, maybe with NEV, but our bottom line is going to increase. That starting point base case is going to be $183,000 more. So that's actually going to probably soften a little bit of that risk position when we're looking at a percentage change, because we're more profitable. So taking on risk isn't necessarily a bad thing. We want to be rewarded for what we're doing. So looking at a comparison of that before and after, examiners love to see this, because not only are we testing the standard baseline position, you can see in this exercise that this line is showing that we probably had too much cash sitting there. We really need to invest that. And what happens when we do so? So we're going to make more money, but we're going to have some more risky looking sensitivity. But again, it's very healthy position. We have a policy limit to guide us to how much risk is appropriate for us and what we can handle, and making sure that we're still staying within those limits. Are we doing the right activities to see the benefit of that boost of income, but also being sure that our risk matches that exercise? And as we get to the bottom section here, looking at our NEV sensitivity and that value, we add duration. That value is going to take a little bit more of a hit as rates go upward, because they're locked in at a little bit lower rate versus if rates go up 300 basis points. But that's okay. Again, we're still within this policy limit. So doing these tests are a great way of showing that we know what we're planning on doing and we understand our risk position, but we're also ensuring that we're not going to put ourselves outside of those policies, making sure that this is an appropriate balance between our assets and our liabilities.
Yeah, it's a lot of it, Heather. It's about risk management, not risk removal. And so
Absolutely.
making sure we're taking the appropriate amount of risk. And a lot of ways to look at this, I want to maximize the income within the risk that we can take appropriately. And it depends. Some people higher capital or lower capital, different levels of risks are going to be very appropriate. So really it's knowing your risk and managing the best earnings you can within acceptable levels.
So, you want to use this to determine a few things. Is our net interest income impacted as we expect it to do? As we do this exercise, did the output do something very different than we had hoped to accomplish here? And that may happen, and that's okay. That's the purpose of why we do these tests, is to make sure we understand what that impact would look like if it does occur, and making sure the neve is also matching, this movement in the right direction, and then using those policy limits to kind of guide us to what is appropriate. So these exercises are a fantastic tool to use to make sure that not only are our assumptions reasonable, is our plan and our strategic movements that we're going to do going to be appropriate for our balance sheet. And we've used these tools to help make sure that that is reasonable and supportable. And that is the biggest take back that examiners want to see, is that we understand what's going on. We're understanding that everything going into our assumptions, into our balance sheet, is appropriate for us so that we can make the right decisions. So kind of recapping all these moving pieces, we want to make sure we're understanding our risk position, both net interest income sensitivity and neve sensitivity. Are those assumptions reasonable? Are they supportable? We want to make sure that we can explain and confirm that, yes, this is what we would expect to happen. Does our cash flow structure, is that appropriate for what we need to accomplish? Where are opportunities for those higher interest rates and to really boost our margin? Are we shifting out of products such as 30-year mortgages and we're moving those more into HELOC types of items? We're going to see something that's going to be a little bit shorter term, but a nice benefit when it comes to those higher rates. Are we testing these dynamic movements of the balance sheet so we can support those growth strategies? We want to take all these moving pieces to work together to make sure that we have a good plan for the future.
With that, we'll go to the next page for a second. I'm going to open up a little Q&A here, and then we'll come back and talk about our investment 101. Heather, thank you very much. Just some great information. One of the questions that came in, and please get into the Q&A button, is at the bottom or top of your screen, depending on your structure. Move your mouse and you'll see it. Please click on it and put in your questions. One of the questions that came here, Heather, was to explain a little bit difference between a dynamic and a static simulation.
So a static simulation is the regulatory requirement to assume that no balances are going to shift or change over the next 12 months. So if our loan balance begins at $10 million, at the end of that 12 months, the loan balance will continue to be $10 million. So say you have an auto loan that's coming due in month 6, and that customer is deciding that they're just going to get a new car. The assumption is they're going to replace that car. They're going to get a new loan for the same amount and keep that on the balance sheet. But that's going to go back on at a new market rate. Now, a dynamic would be, I'm paying off my car. I'm no longer worried about that loan, but now instead I am going to go look at a recreational vehicle because I want to buy a camper. So you're going to see a movement or a shift, or taking cash and then reinvesting that somewhere else, or we're going to see a reduction of something or a growth of something. So the purpose of that is looking at a dynamic movement, meaning balances are going to move around and shift and change, and our balance sheet size could also shift and change over that 12 months.
Yeah, so another question came in, but I'll just answer a couple came in. But one came in, are all the presentations recorded? I missed ALM 101, and the answer is yes. They are recorded. They're on our YouTube channel. Please reach out to our website. There's links from there, or to your MFA advisor, or you can just Google us and you'll find it there, and you can see all of the presentations. Another question that came in was, if I feel that we are going to have a different shaped yield curve, i.e. long-term rates going up substantially more, can you model that, or is that something that the ALM report models on a quarterly basis?
That is the great part with our model. We have 6 different non-parallel scenarios that we display in the full report. We also display three of those 6 non-parallel shifts in the summary report, which is a great board report. It's just a nice summated 6-page overview of our risk position. And it is important to look at those dynamic movements of the balance sheet. We see that when we do our simulations, but also being able to look at a non-parallel movement of the yield curve really gives us an idea of what does our risk, both net interest income and NIEV, look like in the real world. We know that a balance sheet doesn't stay static for 12 months. We know the yield curve doesn't move parallel either. So being able to have those non-parallel dynamic shifts and movements is a great tool to understand what our risk looks like in that market curve.
Yeah, very, very good point. Another question that came in here was, we're thinking about adding a new product line. Would it make sense, or how easy is it to run a simulation to see how that would affect our interest rate risk position?
We see different types of products all the time, and we have great information on how the value of those products look in the market. So if you're looking to add something that you have not had before, here at McQueen, we've seen that product before. We understand how that moves in the market. So we have the ability to add different types of products and be able to show you what that impact would look like for your balance sheet as we incorporate that in, looking at those movements and kind of adding or expanding what we're looking at doing.
Yeah, I think that's a real good point. And we'll wrap up here with one last question coming in, but I do think it is important. If you're thinking of doing something, you are going to run something, I think it's really important that you actually look and run a simulation if you're thinking, especially if it would be a significant modification. You have a $500 million balance sheet, you're thinking about $100,000, it's not going to do much. But if you're thinking about a $50 million type activity, it's going to be a lot. One question that did come in is how long of life should we have on our non-maturities in a rising rate environment? It's a tough one. We really want to look at what your individual structure is, and we want to make sure that we're looking at your institution and how long deposits stick around. And another question came in: is there a way to audit our ALM tests? And yes, there's some great accounting firms that we know well that do actually audit and review ALM reports. We do have some documentation we provide based off of audits we've had done on our reports, but you can do all sorts of different things. Everyone wants to make sure that you've got good data and we're looking at things correctly, so we're really committed to that. With that, Heather, if you flip back one slide, we do have our next webinar coming up here on May 25th, Investments 101. Super excited about that as we continue our 101 and 201 series. With that, Heather, I'd like to thank you very much for your time, dedication, and knowledge, and for sharing with everyone.
Thank you, Charlie.
And I hope everyone has a wonderful rest of their beautiful, sunny day.
Thank you, everybody. Have a fantastic day.
Thanks, guys.